Hey, this is Jordan, and this is your precious metals market update. This video is being recorded on the late afternoon of Tuesday, July 12th, 2016. Thank you for joining me today. Starting off, we're going to look at the gold miners and the short-term daily candle charts for GDXJ on top and GDX below. And in these charts, we include the 50-day moving average, which provided support at the end of May when I believe the miners corrected around 17% to 18% from top to bottom, depending on which index you look at. So the 50-day moving average provided support there. And today the miners had a bearish reversal, and they could be starting a correction. They've obviously been very overbought since January, but that's a good thing. Markets get overbought when they get out of a bear market, and they stay very overbought for the first year. But if you look at where GDXJ and GDX have come from since the very end of May, I mean, they've had very strong moves. GDXJ, that bottom was around 33, and literally in 5 or 6 weeks, I mean, it's up like 50%, and GDX is up to close the same amount. So they're well above the 50-day moving averages, also well above the 20-day moving averages, and that's a very short-term moving average you can use in addition to the 50-day. But focusing on the 50-day here in support, we can see that there's potential support, starting with GDXJ, potential support around 43. There's an open gap there, and I believe that's the Brexit point. So an open gap there at 43. There's good support at 41, 42. And if we come down to 43, that's about a 10% decline from where we are now. From the top to a fill of that gap, that would be a 15% correction totally for GDXJ. Now for GDX, from the top down to the Brexit gap, that would be a 10% correction. The Brexit gap is down there just below 28, so in the high 27s. GDX also has support in the 26 to 27 area. So these are some targets to look at for potential lows for this correction, if indeed we are today marks the start of a correction. And the miners have also not corrected 20%. So it is possible, looking at these charts. I mean, we noted GDX has support at 26 and 27. And with the high around 31, I believe, I guess it would have to go into the 26s to correct 20%. But look, it's possible that this correction doesn't just fill the Brexit gap, but it goes a little bit lower to those other support lines that we have there. So keep that in mind. That's also possible. Now, turning to the metal, here's a weekly candle chart of gold, and there's 3 days left in the week. So it's premature to look at a weekly chart, but assuming this is a negative week, gold, if it's a negative week, we can project that this correction could continue down to 1300. That's really where the next support is, even at 1280. So there should be strong support around 1280, support at 1300. Right now, the key initial support is around 1330 to 1335. So if we push down below that, gold will almost certainly test 1300 and perhaps even 1280. So it would not surprise me to see gold have a print in the 1200s. But for precious metals bulls out there, this is a good thing. The market had really a vertical move from the low 1200s up to 1375. So it's good that if it goes down, because it needs some correction. And one thing to note, the 38% retracement of the entire bear market, that level is around 1375. So that's kind of the resistance that is causing this correction, if indeed there is a cause. So keep that in mind, that 1375 again, and also there's clear resistance at 1400. Now, going back down to support, the major long-term moving averages, the 80 and 160 week, and those are equivalent to the 20-month and 40-month moving averages. Look at gold's history and look at the 40-month moving average. It's been a perfect indicator. And of course, after this Brexit situation, gold has gone way above that, and that's now at 1232 and starting to curl up. So good night gold bears in that regard. You really needed to hold the 40-month moving average. That was the last month of defense. And obviously, if you know my work, you know that I focus quite a bit on the 400-day or 80-week moving average, and that's equivalent to the 20-month moving average. And as you can see, that's at 1187 and turning up. So again, if we have a correction here down to 1280 to 1300, very healthy for this market. In the big picture, I still think that this rebound is probably going to go to 1550. Now, the only thing that stands in the way of that is resistance at 1375 to 1400. And if gold can take that out, then it almost certainly, I shouldn't say certainly, but it's almost very likely to go to 1550. And I'm looking for that in the next 6 to 8 months. And keep your eye on the monthly chart. We're about at the middle of the month here in July. On the monthly chart, I believe there's monthly resistance around 1330. So that's something we can watch in the next couple weeks to see if gold closes above that or it doesn't, which would perhaps imply more weakness than we expect during this correction. Now, I don't want to spend too much time on the gold commitment of traders report because I've talked about it numerous times since February. There's all these people who are talking about record longs in gold. Excuse me. The smart money is record short. We've debunked a lot of these things over in past months in our videos, and there are a lot of people who got really cautious on gold because of the COT in February, and we've been talking about why it would not derail the rally. And similar points we want to make in this video. Again, we look at the net position as a percentage of open interest. It gives us a consistent read of the market over time, over many, many years. And as we can see here, the peak in the net speculative position tends to be around 60%. I consider 50 to 60% fairly overbought, and we hit 54% a few weeks ago. Now we're at 52% as of last Tuesday. Assuming we get this correction, we'll probably fall back below 50%. But a point I want to make is, based on my statistics, look at the horizontal lines here. You could pause the video in a couple seconds after I describe this, but look at the horizontal lines in 2003, 2004, also 2005, and 2009. Those were points when, even by my metric, the COT became, it was showing that there was a lot of speculation in the market. Speculation was very, very high. Look at the peaks there in 2009, at the end of 2005. Well, what happened? Yeah, gold may have corrected for a couple days or a week or two, but in the months to come, gold kept moving higher, and that's because in 2005 you had a major breakout above 500, and then in 2009 you had a major breakout above 1,000, and perhaps we're going to see that repeat itself with gold breaking above 1,300. That's a multi-year breakout, and look, it's also possible when gold has a big breakout like that, it's possible that the commercials have to cover some of their shorts because they don't want to get caught and lose a lot of money. So that is why you can see gold continue to move higher even in the face of a very high net speculative position. And last thing here, this is a updated chart of my junior gold index and the bull analog, which shows the cyclical bull from 2008 to 2011 there in red, but also the cyclical bull from 2001 to the 2006 top. It actually topped in 2007, but I haven't been showing this much time in the charts, but it really shows you how much juniors can rise over, beyond just a couple years. We know that there's huge potential upside if this bull market follows the other two. There's huge potential upside over the next couple years, but look how high the market went from 2001 to 2006, and again, there was still a move from late 2006 into 2007. There was still a huge move there, and if you look at valuations in the market, and you've read my book, you'll know that the low that we had in January 2016, it's very comparable to the low we had in 2001. Really a potential secular low. The 2008 low, that was not a secular low. So I do think this bull market is far more likely to follow the blue path here than the red path, at least over the long term, over 3, 4, 5, 6 years. But looking at the Huey and the GDX and my Huey bull analog, I have not shown that, but it does show that the large cap stocks are definitely overbought. They're definitely very stretched in the upside potential. While it's there from these price levels, it's going to be limited in the months ahead, although I do think that we're going to continue to move higher. Again, the real upside is going to be in the junior sector, and as this analog shows, and I firmly believe that. Again, the real upside is going to be in the junior sector, and you have to be able to pick the right companies and be invested in the leaders and the winners, and that's how you're going to make huge returns. And with that said, that's the end of this video. Thank you so much for listening and watching. You can follow more of my work at thedailygold.com. I give away a lot of excellent free stuff in my weekly newsletter that I send out on Sundays. That's a free newsletter. Consider my subscriber service. We do a comprehensive weekly update. We send it to you every Saturday evening. We also send, on average, about one flash update a week. As of yesterday, the model portfolio, which I started 7 years ago, I started the Daily Gold about 7 years ago. Our model portfolio was up 400%. And that was during a period in which the miners were down around 30%. That's GDX. If you look at junior indices, they're down even more. That junior index, those analogs I showed you, my junior index is up, I think, 115% in that period. So again, picking the right stocks and having good timing, that's how you can make big returns in this sector when it's in a bull market. Again, consider my premium service. It costs less than $1 a day. On that note, thank you so much for listening and watching to this video. I really appreciate it. Thank you for tuning in. I wish you all prosperity and health, and look forward to seeing you again in the next week or two with another update.